Hi everyone, it's Matt. Welcome back to the FX trading course. In this video, we're going to take a look at account management and position sizing in FX trading. Let's have a quick look back at what we've learned so far. In part one of the course, we looked at an introduction to FX trading, and I took you through the different currencies I trade, why I trade FX, and how I trade FX. Then in part two, we looked at the components of an FX trade. So I looked at the different currencies that are there, the concept of going long and short, because there are always two currencies that we're dealing with. We looked at the bid-ask spread, we looked at margin, tick size, tick value, and financing, and of course we looked at reward to risk ratio on the trade. Now, since we recorded that video, there have been some changes in the way that margins are dealt with in different countries, but we'll take a look at that in a moment. In part three of the series, I took you through an FX trade and showed you how it all works, how it looks when you're in the trade. As you can see, your profit and loss in your account moving up and down, and everything that happens in real time as an FX trade unfolds. And you'll see in that video that I made a profit of $500 in just a few minutes in the market. So if you haven't watched these three videos, I'd encourage you to check them out before continuing with this FX series, particularly videos 2 and 3. Still to come in the series, we've got part 4, which is this video here, where we're going to take a look at account management and position sizing. Position sizing is particularly important. I remember the very first FX trade that I took was actually 10 times larger than I had intended to take. So it's very important that we get position sizing right. In part 5, we'll then move on to our analysis. We'll look at both fundamental and technical analysis. In part 6, we'll then go back in time a little bit and we'll have a look at some lessons from history. As many of our safety in the market students would be aware, history repeats all the time. So there are many lessons that we can learn from history. I'll walk you through some famous examples from the FX markets, and we'll see what lessons we can extract from those. Then in part 7, we're going to wrap the FX trading course up, and I'm going to walk you through setting up for an FX trade from scratch. So as you can see, there's plenty still to come. Before we get into today's lesson, let's just have a quick recap of FX trading in a nutshell. Remember that in FX trading, we always have two currencies. So as you can see at the top here, Aussie dollar, US dollar. We're not trading the Aussie dollar by itself. We're not trading the US dollar by itself. We're trading one against the other. So in this case, you usually say 1 Australian dollar or currency 1 buys X units of currency 2, which is US dollars. When you're talking about position sizing, which we're going to do today, position sizing is always based in currency number 1. And therefore your margin, which is a percentage of the position size, is also going to be denominated in currency number 1. The tick size in currencies, I still deal in 4 decimal places. You will find a lot of brokers offering 5 decimal places, some even 6, but you get to a certain point where extra decimal places, they're just minuscule and they just complicate things a little bit. So I find 4 decimal places is usually the easiest way to calculate these. You will notice, of course, that a couple of these currency pairs only have tick sizes going to 2 decimal places, and that's where the Japanese yen is involved. Finally, the tick value. If you're trading a $10,000 position, then for the Australian dollar, US dollar, each tick or movement of 0.0001 is going to be 1 US dollar. If you're looking at 5 decimal places, well, that 5th decimal place, every 1 tick that 5th decimal place moves is going to be worth 10 US cents. So a quick summary, if you're looking at position size or margin, that's always going to be denominated in currency number 1. So that's Aussie dollar here, pound, US dollar, euro, US dollar, etc. And when you're working out your profit or your loss on the trade, that's always going to be denominated or paid in unit of currency number 2. So in this case, US dollar, Canadian dollar. Once you've taken your first few FX trades, this all becomes second nature to you. I know that if you haven't traded before, this may look a little bit confusing, but as I've said right from the start of this FX trading course, FX trading is actually a lot easier than it looks. So don't be put off, hang in there. And as I said in the last video, maybe what you need to do is just open up a demo trading account and take 1 or 2 virtual trades, and you'll start to see the lights come on. At least that's how it was for me. I went from, oh, FX trading, this is very confusing, I don't need to do this, to, oh, what's this, FX trading, click, I took a trade, and I'm like, oh, that's how it works. It really is that straightforward. So in this video, we're going to take a look at 2 topics. We're going to look at account management, where we'll talk about things like margin calls and how to deal with them, And then we're going to look at position sizing. And with position sizing, we're going to talk about the percentage of your account to risk and also the position sizing formula so that you can very quickly work out on any trade exactly how much of that position you should take. And that's really important to know. You're going to find some great opportunities happen in the markets, but there is a trading window with which you can enter that opportunity. It's not a case of, oh, I found this trade, I'll get in when I feel like it. Sometimes it's a case of, well, I can see this trade coming because I've put in a price forecast, I've picked this top or bottom, and I can see it coming, and then bang, the opportunity arrives and you've got maybe an hour's window to get into that trade. Otherwise, you've missed the best entry and your reward to risk ratio goes down. So it's very important when you get the trigger, when you get that signal to enter into the trade, you need to be able to calculate your position size straight away. And it's easy to do once you've done a few of them. And I'm going to walk you through each step of it in this video. So let's start with a quick recap of what margin is. If we've got a $10,000 account, we know that we can take more than $10,000 worth of positions using leverage. And the analogy that I often use is it's like buying a house with a mortgage. We need to put up some margin or deposit in order to take that trade. And the same thing goes in financial markets. You see, if you buy a house, the typical margin or deposit that you will put up for that house is 20%. So if you buy $1 million house, you might put up a $200,000 deposit. Now, if the house goes down in value, you're not going to get a phone call from the bank saying, hey, please give us some more money quickly. You've put up your deposit, and all you need to do is continue paying your loan, and you won't have any problems. Let's say house prices collapse, and let's say they fall by 50% in value, and now you've got an $800,000 loan on that house, but your house is only worth $500,000. If you were to sell that house, you'd only get $500,000 for it, and you'd pay off some of the loan, but you'd still have a $300,000 loan. That's what we would call negative equity. Now, a lot of people found themselves in that position in the US and the UK during the global financial crisis in 2008, 2009. Here in Australia, we avoided that situation. So again, the theory goes on that house prices in Australia always go up. And of course, interest rates always go down, or at least that's what people think, because for the last 20 or 30 years, that's basically been the story here in Australia. However, with inflation rearing its ugly head, it would not surprise me to see interest rates going up, and it wouldn't surprise me to see them go up a little bit more than people expect in a much shorter time frame than people expect as well. Many of you would be familiar with the 1992 British pound crash, or you probably don't know it by that name. You may know it by the phrase the George Soros trade. That's a trade that George Soros became very famous for because he made $1 billion from a single day's worth of trading. And we're going to talk about that in part 6 of this course. But on that day, the Bank of England actually raised interest rates twice in one day. They raised them by 2% in the morning and by 3% in the afternoon. That's a total of 5% in a single day. So I know people think, oh, the government or the central bank, they won't let interest rates go up. They won't let people get hurt like that. But the fact is that you can look back through history, and sometimes central banks and governments, they don't have a choice. They have to take drastic action. Now, in the housing market, as long as you can pay your loan, you're not going to get the bank calling you and saying, hey, give us more money. If you have a variable loan, your interest payments are going to go up, obviously. But as long as you can pay those, there's not going to be any problem. In financial markets, however, it's a different story. If the value of our portfolio drops below our margin level, we're going to get what's called a margin call. And I'm going to explain to you what that is in just a moment. But just think of margin as the deposit that we put up, or the security deposit that we put up in order to trade on borrowed money or to trade with leverage. Now, as I mentioned at the start of this video, there has been an update to margins. Australian laws have changed since we recorded video 3, and margins have been increased during that time. FX majors, so the Aussie dollar, US dollar, or the US dollar, Canadian dollar, or the US dollar, Swiss franc, the margin has gone up significantly. It used to be 0.5% for a lot of brokers. Now it's gone up to a minimum of 3.33%. So what does this mean for you as an FX trader? Well, if you wanted to take $1 million position in a currency like the Aussie dollar, US dollar, at 0.5% margin, you need $5,000 in your account to take that $1 million position. At 3.33% margin, the new margin, you need $33,000 to take that same position. So that's a pretty big jump. Now, a lot of traders were disappointed when these laws came out because obviously it means you need more money in your account to take that same position size. So overall, traders are going to have to take smaller positions. But I see this as a good thing. The fact of the matter is the majority of traders, so more than 50%, the number gets thrown around, different numbers. Some say 50, 60, some say 80, 90%. But a lot of traders lose money from trading. And there are all sorts of reasons why they lose money, over trading, not using stop losses, etc. But for most people, it's because they underestimate trading. They think, oh, I'm a smart person. I've operated my business for 20 years. I can do trading, no problems whatsoever. I remember starting out in trading thinking I'm good with numbers. Maths was my specialty. I got high marks in the HSC at maths. I've done a few years working as an accountant. This is going to be really easy. And then I lost $30,000 over about 2 nights worth of trading, which was the bulk of my trading account at that time. So I know what it's like to lose money, and I've seen it happen over and over again in the markets where people don't bother to get educated first. They just go running in and trading the market. They don't look at what's happened in the past, as we're going to be doing. They don't get educated, as we're going to be looking at over this FX trading course. They just simply run into the market. So I can understand the laws being changed to protect people like that. And as I tell our students, as you develop your skills and you take better trades, you can still take more than enough in position sizes to trade for a living as a trader. So we'll talk about all of that as we move on. But just keep in mind as well, if you're actually deemed to be a professional trader, your broker may be able to offer you better margin rates than this. You'll have to speak to your broker to see if you qualify. Different brokers have different criteria for that. But as I said, higher margin rates are not necessarily a bad thing. For many traders, they are going to be a good thing. They're going to slow you down and give you that time in the market to build your skill level, build your experience level. Now, I mentioned earlier that if your account falls below a certain level, you're going to receive a margin call. Now, for those of you lucky enough to have not received a margin call is when the broker contacts you, either by phone or by email, and they ask you to deposit more money into your trading account. Now, that's never a good thing. It's never the case that you're making money, the market's going in your favor, and the broker rings you up and say, hey, can you deposit more money in your account? They're calling you because your account position has fallen, the value of the assets in your portfolio have fallen, and they've fallen below that required margin level, so you need to deposit more money or close some positions. So for example, if you've got a $10,000 account, you might tie up $500 in margin, you might tie up $5,000 in margin, or as you can see here, maybe you want to put all that money to use and tie up $9,500 in margin. Now, if your account value falls below $9,500, you will be asked to deposit more money or to close some positions. So the way that they work that out is they look at how much cash is in your account, and then they will look at your open positions. And if the total of those open positions show a loss of more than $500, that's going to bring your $10,000 account value, even though you haven't closed any trades, but it's going to bring that value of your account down below $9,500. And in that case, they will say, well, the value of all of your positions, if they were to be closed out now, is less than $9,500, which is the amount that we need from you. So you either need to deposit more money or close some positions. Now, when that happens, and I can tell you I've had more than one margin call in my life, and they're never fun, but when that happens, you do have options. Option number one is to deposit more money into your account, and the broker will usually give you until the end of the day, for example. So if you've got cash on hand, you can simply put some money into your account and make the problem go away. Option number two is you can close some or all of your positions. Now, either of those options will do the same thing. They will free up more margin in your account. And then once you've got enough margin to cover your open positions, you're not going to be in a state of margin call anymore, and it's business as usual. There is a third option, and that option is that the broker will actually close your positions for you if your account drops by too much. And I think that's a terrible option because they're not going to look at your trades and say, well, you've got 5 trades on here. I'm going to close the worst looking 2. They will just indiscriminately either close a couple of trades to bring you back under the margin level, or they'll just close everything out. David Bowden, the founder of Safety in the Market, tells a story of a friend of his who owned shares in Poseidon, which was a company that had a massive boom many, many years back. And this trader actually got a margin call, and they said to the broker, you can close other positions out, that's no problem, but don't close out my Poseidon position. I want to keep that. Now, in that case, the broker didn't sit there and say, oh, well, I'll leave Poseidon open. They just closed everything. And what actually happened, Poseidon, you can look it up on Google. It was a massive boom, one of the biggest booms in Australian stock market history. And of course, the trader was kicked out of that by not having enough margin in the account. So option number 3 is not a favorable option. And as I said, anytime you're getting a margin call, it's not a good thing. It generally means that you're over trading. And at the very least, it means something is wrong in the market. Your initial market outlook, where you think the market's going, your initial prognosis for the market was incorrect. So as I said, that's not a good thing. I want to share with you some really good advice now on the best way that I've heard to handle a margin call. And this advice comes from a trader called W.D. Gann. Now, if you've been a student of safety in the market for a little while, you'll know all about W.D. Gann and who he was. If you're not familiar with Gann, Gann was a trader from the 1900s. He's a very famous trader. He wrote several books and courses on both trading and forecasting financial markets. And he was known for predicting the 1929 crash in shares and making a fortune short trading the market as it fell. He was both a trader and a broker, and he wrote a great book called 45 Years in Wall Street. He wrote a lot of great books and courses, but this particular one, 45 Years in Wall Street, gives you an idea as to just how long he was around trading and the markets and other traders. This is not some guy who's just discovered trading last week and decided to make some videos for it on his YouTube channel. This is someone who had walked the walk and talked the talk for 45 years. So that's the kind of advice that I want to listen to in the markets. Now, when it came to margin calls, W.D. Gann was very specific and very direct. He said, the thing to do in most cases is not to put up more margin, but sell out of your positions at the market or buy in case you are short. So if you've got a long trade, sell it out. If you've got a short trade, buy it back in. But in other words, close your position out. Gann says, if you want to put up more margin, let it be on a new trade and one which you have good reason for making when your judgment is better. So if you get a margin call, get out of the market, clear your head, and then put your new margin, if you wish, into a new trade. Don't keep throwing money at a bad trade, because remember, if you're getting the margin call, it means something was wrong with your initial judgment on the trade and the trade is going against you. So don't throw good money after bad money. That's taken from W.D. Gann's book, 45 Years in Wall Street, which I highly recommend as well. And Gann goes on to say, 9 times out of 10, that's 90% of the time, that's the vast majority of time. 9 times out of 10, after a customer puts up margin the first time, he will hold on until there is a second margin call and a third, and put up as long as he has money to put up and lose all of his capital on one trade. If the broker has to call you for margin, there is something wrong, and the best thing to do is get out. And honestly, based on my 15 years of experience trading and my years of experience as a teacher and a coach and working with other traders, that's the best advice I've ever heard on handling a margin call. It never goes your way. The market never turns around and says you're best off just taking your medicine and getting out of the trade. Again, remember, this is someone who had been around trading and traders for 45 years. And as a broker, you can imagine he would have dealt with a lot of customers who had margin calls. And he's saying 9 times out of 10, it never ends well. They keep putting up margin, and eventually they lose all their capital and they end up getting closed out of the trade anyway. So you're better off just taking your loss and moving on. Now, there's been a lot said about W.D. Gann and a lot written about him over the years. And the comments about Gann are on both sides of the spectrum. They go all the way up to he's a financial genius, couldn't put a step wrong, to all the way down to he couldn't make money except by selling books and courses. Now, we will probably never know for sure how much money Gann made from trading. People who say Gann couldn't trade will quote his son, John Gann, who said that Gann died and only left $100,000 estate. Now, when Gann died in 1955, $100,000 was still a pretty useful sum. And of course, not everybody just leaves all of their money to their family. But we'll never know exactly how much money Gann made from the market. All we can do is take what he has taught us and put it to the test today. And again, students who have been around safety in the market for a little while will know that in the months leading up to the November 2021 top on the NASDAQ, I was calling for a top around 16,700 in that market, and we got a top at 16,767, and the market fell several thousand points from there in just a couple of months. And that work that I put together there was all based on the work of W.D. Gann. So I've seen this time and time again. David Bowden, the founder of Safety in the Market, had some terrifically successful calls in the 1980s. He predicted the 1987 top. He called the 89 top of the Australian share market a year in advance, and he got the price exactly right. So to David has proven to himself that Gann's techniques work. I've proven to myself that Gann's techniques work. So I don't listen to what other people say. I look at the work and I see the results that are gained from following that work. And I know that the techniques are fantastic. They're second to none. I don't know anyone else out there who was actually calling for a top in the NASDAQ at that time, let alone a price of 16,700. And in the lead up to that NASDAQ top, you could have adjusted your price forecast and fine-tuned it to the point where you could call that top to within a single point on a 16,767 point index. Now, if that doesn't impress you about W.D. Gann's work, well, trading may not be for you. It's certainly impressed me, and it's certainly impressed our students who were making double-digit reward to risk ratios shorting that market last year. So from my personal experience, of course, I strongly recommend the works of W.D. Gann. And if you're looking to get started with W.D. Gann's work, the best place I would suggest that you look is Safety in the Market's Active Trader Program. And you can get started working your way through that immediately at no charge by clicking on the link in the description to this video and watching those initial videos in the Active Trader Program at no charge. So I'd strongly encourage you to do that if you haven't done that already. Now, in the Active Trader Program, David Bowden actually gives us 2 rules when it comes to margin and controlling our margin in our account. And this is to avoid getting margin calls in the first place. So rule number 1, David says, don't have more than 30% of your account tied up in margin in any one stock or index or currency. And the reason for this is that things happen in the market sometimes completely out of nowhere. So I know that sometimes people like Warren Buffett will say, put all of your eggs in one basket and then watch that basket very closely. But there are times in the market where just one specific stock, like Facebook we saw in February 2022, fell 25% overnight. Or the Swiss franc had massive multi-thousands of points of swings when it unpegged itself from the euro, and that came out of nowhere. That was a single announcement, and then bang, you literally didn't have any reaction time. The market just moved. And you can learn more about that if you look at our trading case studies video and you look at the Euro Swiss franc peg. And we'll talk about that in our lessons from history in part 6 of this series. But you don't know when your particular market might have one of those black swan events. And that's why David's saying don't have more than 30% of your account tied up in margin in any one stock or any one index or any one currency. The second rule David gives us is don't have more than 50% of your account tied up in margin at any one time at all. Now, if you follow these 2 rules, you're almost certainly never going to get a margin call in your life, okay? Now, I know there's always going to be some people who like to live on the edge and they like to push their trading account and flog it for all it's worth and try and squeeze every last penny out of it. That's fine. That's your decision to make. But if you don't want the stress and pressure of margin calls and you don't want to risk having to close your positions out, and if you're closing positions, they're probably going to be at a loss. So if you don't want to be in that situation, well, follow these 2 rules and you'll be fine. That should save you from getting a margin call ever in your life. So let's talk about position sizing now. When you buy a house, most people buy one house at a time. I think we're all pretty familiar with that. In financial markets, we trade a number of shares at a time or a number of contracts at a time, or in our case in FX trading, we're trading a set unit at a time. So we might be trading $150,000 of the currency pair. We might trade 175,000 or 350 million of that pair. But there's going to be a position size. And in FX trading, our position sizes are determined by 2 things. Number 1, the percentage of the account that you're prepared to risk. So some people will risk 1%, 2%, 3% of their account on each trade. And obviously, if you're taking the exact same trade as someone, you're risking 2% of the account and they're risking 1% of the same sized account, well, your position is going to be bigger than theirs. So percentage of account will be one factor in your position size, and the reward to risk ratio on each individual trade is going to be the other factor. I'll explain this more as we go through the video, But reward to risk ratio is one of the most important things in trading. In fact, on this YouTube channel, under the Trading Accelerators playlist, there's a video on there called Trading the Easy Way, and I strongly recommend that you watch it. But in that video, we talk about the importance of a reward to risk ratio. The higher your reward to risk ratio is, the more likely you are to be a successful trader. And in position sizing, the lower your risk is on a trade. So the closer that you can get into a market near your stop loss, the bigger your position size is going to be for the same amount of risk. And we're going to explore all that in the rest of this video. So as an example here of position sizing, you'll find that when you go to take a trade, your broker will normally tell you based on the parameters that you enter. So here we've got just an example. This wasn't a real trade, but if you type in an order price to buy at 72.70 and you put a stop loss at 72.50 and a take profit at 75.56, it's going to tell you that your risk is this amount, $20 US. In this case, we can tell because it's $20. It doesn't tell us what currency it is, but we're trading the Aussie dollar, US dollar. So we know that this profit and loss is going to be in US dollars. And then the profit here, $286, is also in US dollars. So you would convert those back to Australian dollars. And I'll show you the formula for doing that. Very importantly, two things to keep in mind here. Number one, always check these figures, no matter how confident you are that you've got it correct. Always check this before you click on the place order button, especially the stop loss here, to make sure that you haven't dropped an extra zero in maybe in your quantity up here, or maybe you've left a zero off over here and that's going to throw your price out to be a lot further away than you thought it would be. But check this to make sure you know how much you're risking on the trade before you get in. And of course, check to see if you can get a 10-to-1 reward to risk ratio here or not. For me, 10-to-1 is the standard when you're entering a trade. You should be looking for 10-to-1 or more. Now, I know a lot of people at this point will be thinking, how can I possibly make a 10-to-1 trade in the market? But trust me, safety in the market students, once they've seen how to get a 10-to-1 reward to risk ratio trade, they'll actually find that that becomes their minimum level. Whereas in the past, it would be, 10-to-1, that's too far away, I can never get that. Then it becomes 10-to-1, that's the minimum I'll settle for. I'm going to look for 15-to-1 or 20-to-1 or 30-to-1. So again, here in the broker's platform, you'll be able to double check all of this work before you take the trade, and I'd encourage you to do that. So in order to work out our position size, we need to start by working out what percentage of our account we want to risk if we're wrong on the trade. Now, I know this is going to be very hard for some of you to accept, but no matter how good you get at trading, no matter how much study you do, how much work you do, you are going to be wrong from time to time in the markets. W.D. Gann was tracked by a journalist for a month, and I think it was 286 trades that he took during that period, and 264 of them were winning trades. Okay, and people look at that and say, wow, Gann had a 90+ success rate. But what they don't realize is even Gann, the master with that high level of success, was still wrong about 1 in every 10 trades. Now, if Gann can be wrong 1 in 10 trades, we can be wrong 1 in 10 trades or more. So we need to accept that we could be wrong. And let's say you're wrong 1 in 10 trades. Let's say you're a brilliant trader and you're only wrong 1 out of every 10 trades. That would be 10 trades out of every 100. What if you're trading and you're taking 100 trades, but the first 4 of those 100 trades end up being losses? You have to accept that sometimes you'll have a bad run like that. So when you're saying, oh yeah, I'll risk X amount on my account, ask yourself, well, what if I'm wrong 4 or 5 times in a row? How would I feel then? So as I said, in trading, there will be these times when you're wrong. Ask yourself, what is your track record as a trader? How long have you been doing this? Do you have a track record like Gann where you can say, well, here's my last 1,000 trades or my last 500 or my last 200 trades, and I've got 90% of them correct? I mean, people just assume that they're going to get that high level of success, but they don't have the track record to back it up. Then ask yourself, based on your track record and based on how well you know yourself, how many times in a row could you be wrong and still remain calm and not let it affect you? If you're wrong once in the market, how are you going to feel? What if you're wrong 2 times in a row? What if you're wrong 3 times in a row? When is it going to start to affect you? And how much money can you afford to lose without letting it affect you? Now, nobody likes taking losses. There's never going to be a loss where you go, oh, yay, I just lost $5,000. It doesn't work like that. But it needs to feel small enough that it's not going to upset you, because if it upsets you, you're either going to try and chase it by taking a bigger trade or by jumping in too early to a trade, or you're not going to be able to take the next trade and you might miss out on a winner. So I recommend never risking more than 5% of your account on any one trade, but that doesn't mean go out and risk 5%. I'm saying never risk any more than 5%. That's the upper limit. In trading, we don't have a boss. You can risk your whole account on a single trade and nobody, not even your broker, is going to stop you. Okay, but that doesn't make it a good idea. So maximum 5%, but when you're starting out, why not start with a maximum risk of 1% or 2% of your account? People will look at that and they'll say, yeah, but I only have a $500 account and 1% of that is $5. And if I'm risking $5, I'm not going to make very much money. Well, in a moment, we're going to look at an example of a couple of trades that I took in January of this year. And the combined reward to risk ratio on those two trades is 30%. Now, if you make 30% on your account in a month, and you can do that a few months of the year, it's not going to take you long. It might take you 2 or 3 years gradually to grow that account up to a significant amount, but you're going to be able to do it. So the size of the account has never hindered a good trader. And you'll see it with Gann in many of his books. He talks about opening an account, starting with a few $100s, running it up to $10,000, $12,000, and then withdrawing a lot of the capital and just trading with the market's money. That's something that he would do, and then he could trade very aggressively with that. So the size of the account has never hindered anyone. It's the size of the education, the size of the knowledge, it's the size of the experience. So if you're good enough as a trader, any account size is enough. Now, looking at that 1 or 2% of your account, at 2% risk, you would have to be wrong 10 times in a row to lose 20% of your account. Now, could you be wrong 10 times in a row? I'd like to think that after time number 3 or 4 or 5, you would sit back and say, I must be doing something wrong. I better go back and do a little bit more work and research and back testing and just make sure I understand this plan properly. But let's say you don't. Let's say you do have 10 trades in a row. Maybe you're incredibly unlucky and you get stopped out 10 times in a row. But at least at 2% risk, you've only lost 20% of your account. Now, 20% is a fair whack to lose. But as I said, even if you're only risking, say, 1% of your account, if you make a 30-to-1 campaign, as I did on the Aussie dollar this year, you're going to make back those 10 losses and then still have profit left over. So with a high reward to risk ratio, 10 times losing in a row is not the end of the world if you're doing it with a small amount of risk. If you're risking 5% on each trade and you're wrong 10 times in a row, you've now lost half of your account. And that's a much bigger hit and a much tougher setback to pull yourself back from. Now, at 1% risk, you'd have to be wrong 20 times in a row to lose 20% of your account. And if you can honestly say that you've done all of your work and you've been through your education and you've tested it and seen how it worked in the past to make sure that you understand it, I don't know anyone who has been wrong 20 times in a row without a profit in there. And if you couple that with my previous advice, which is to focus on trades with a high reward to risk ratio, then even if you only have a few winning trades in that batch of 20, you're still actually going to be profitable. So resist that urge. And I know that with the change in margin laws, the government are helping you to resist that urge by taking away your ability to take a massive position on a tiny amount of money. But resist that urge, start with a small amount of risk and just build your skill level, build your experience, and the position sizes will grow as your account grows over time. So percentage risk is one of the factors that will determine our position size. The other, of course, is the reward to risk ratio. The reward to risk ratio on a trade is going to have an impact on your position sizing. As I said earlier, the smaller the risk on the trade, the larger your position is going to be. And sometimes your position will be so large, you might not actually be able to take all of it and still remain within your limits. So as an example of that, think about the NASDAQ top that I spoke about from November 2021. Leading into the top, if you stuck with that market, you could have called that top to within 1 point. Now, if you took that trade and you had to stop maybe 5 points away or 10 points away, you can take a much larger position size than someone whose stop loss is 100 points away or 200 points away. Now, if you're not sure how, I'm going to show you, so keep watching. But the more points or ticks that you are risking on a trade, the smaller your position size is going to be. So let's look at an example. Imagine that you're trading stocks or shares, which are the same thing, and you've got 1,000 shares at 10 cents risk. You're going to be risking $100. If you're risking $1 on that same move, you can only afford to take 100 shares for that $100 risk. Now, this is the whole key to what we're about to discuss. So I want to make sure that this really sinks in for you. Look at point number 2 here. The more points or ticks that you risk on a trade, the smaller your position size will be. And I probably should have said there, the smaller your position size will be for the same dollar risk. So here's the same dollar risk, $100, $100. At $1 risk per share, you can take 100 shares. If you go smaller, all the way down to 10 cents risk, you can take 1,000 shares. Same risk, if you're wrong, you lose $100. But if the stock goes up by $1, on this one, you make $1 times 100 shares. On this one, you make $1 times 1,000 shares. Now, I know you're probably thinking, this is an FX trading course. Why are you talking about shares? Well, this particular application is a little bit easier to explain with shares, but we're going to do the exact same thing now with currencies. So let's look at some FX examples. If you watched the video Trading the Easy Way, which is in the Trading Accelerators playlist on our Safety in the Market YouTube channel, you'd be very familiar with this example. These two circles represent two short trades that I took on the Aussie dollar US dollar pair in January of 2022. The first was the 13th of January high, where I had an entry of 72.91. Now the high of that day was 73.14. I put my stop 1 point above the high. I'm not going to get into the nitty-gritty details of calling these tops or of entering the market, of managing the trade, all of that. This is just about position sizing and reward to risk ratio. We're going to walk it through for these examples. But the first trade there, entry at 72.91, second trade, entry at 72.62, stop losses 1 point above the high, and target down here at 69.93. Now, I initially had a price target going a little bit further, but I saw the double bottoms, did some work around those lows, and I thought there's a pretty good chance we're going to rally from there. So I took profits there for a 30-to-1 campaign. Not bad for a couple of weeks trading. Have a think about the percentage that you want to risk on your account, and then turn that into a dollar amount that you're going to risk on each trade. Then multiply that by 30, and if that was your result for 1 month, how would you feel? I can tell you, I felt pretty good. So let's walk through these examples now and look at the position sizing behind them. Let's assume you've got a $10,000 trading account. You might have a lot more, you might have a lot less, but let's work with 10,000. And for the purposes of this exercise, we'll say that your account is in Australian dollars. You're prepared to risk 2% of your account on each trade. You might be prepared to risk more or less, but we're going to go with 2%. Now, 2% of 10,000 Australian dollars is 200 Australian dollars. Now, if you're wondering why I'm emphasizing the fact that it's Australian dollars, remember our FX table from earlier. Look at all of these FX pairs. You've got the Aussie dollar US dollar, the pound US dollar, the US Canadian dollar, the euro US dollar Japanese yen, US dollar Swiss franc. None of them have their profit or loss in Australian dollars, but our account is in Australian dollars. Now, this is something that will confuse students, and it can be one of the things that turns them off trading FX. But I ask you just to stay with me because, as I said, you do this once, it'll make sense when you take your first trade, and then it won't be a problem anymore. Could be a barrier for some of you. So just tough this little bit out with me. But we need to convert that $200 into whatever currency we're planning to trade in. So in this example, let's say we're trading the Aussie dollar US dollar. Our profit or loss is going to be in currency number 2, which is US dollars over here. We need to convert our $200 risk into a US dollar equivalent because our profit or loss is going to be calculated in US dollars. Now, it's easier than it sounds. We simply multiply that $200 by the exchange rate. Okay, so it's just one calculation. Now, just remember the exchange rate is going to be different depending on whether we make a profit or a loss on the trade. So let's have a look at that now. Here's our example. Let's assume that we get into this trade. We enter at 72.91 and our stop is up at 73.15. If we get stopped out of the trade, that's the only time our risk is going to come into play. So the number that we're going to use is the price at which we would be stopped out. So if our stop loss is at 73.15, that's the exchange rate that we use. On trade number 2, stop loss was at 7277, 1 point above the high of that day there. 7277, that's the exchange rate that we would use on that trade. So keep that in mind. When you're doing this calculation, use the stop loss price for where you're going to get out at. So in this case, we convert our 200 Australian dollars risk into US dollars using the price of our stop loss. In this example, the stop loss was at 0.7315, or I normally, when I'm quoting the price, I'll just say 73.15. And to convert this to US dollars, we simply multiply the 200 by the exchange rate, and that gives us 146.3 US dollars. Now, our risk on the trade is in the same currency as our profit and loss is going to be. And we can just slot it straight into our position sizing formula, which I'm about to take you through. So if we are prepared to risk 200 Australian dollars on this trade, we can risk 146.3 US dollars. So here's our position sizing formula. Position size equals your dollar risk divided by your points risked. So dollar risk divided by points risked. We have one of these figures already. We know that our dollar risk is going to be 143.6. So the position size, therefore, is going to depend on the points that are risked. So we're not changing the $143 in this case. We're prepared to risk $200. How close we get in to the turn will determine how many points we're going to risk, and of course, how big our position size will be. So if we get in with 10 points of risk, so we get in really close to the turn, 146.3 divided by 10 points, so in this case 0.0010, we could take a position of $143,600. Now, $143,600 multiplied by 3.33%, by the way, that's 143,000 Australian dollars, but at 3.33% margin, that is 4,781 Australian dollars. So we would be within our margin rules for the whole account, but we would be exceeding 30% of the account. So we've got a $10,000 account. The margin on a position like that would be 3.33% of 143,000, which is $4,781. So 30% of 10,000 would be $3,000. We would want our margin for this position to be $3,000 or less. So this one we couldn't actually take. If the risk was 15 points, well, 146.3 divided by 0.0015, we could take a position size of 95,733 Australian dollars. Can you see already, as soon as we start increasing the number of points that we're risking, our position size comes down for the same amount of dollar risk? That's one of the most important things that you need to learn as an FX trader. The closer that you can get into the turns means that the bigger position size you can take for the same amount of risk, which means that your reward to risk ratio grows and grows and grows. So the goal here is to eventually learn how to predict tops and bottoms in the market before they happen so that you can recognize the opportunities early enough and get in very close to those turns. That's what I did on the Aussie dollar. I called that January 13 top. I was a little bit late on the January 13 top. I was about 4 hours late. I worked out the top about 4 hours after it happened. Whereas the second top there that I showed you, which was the 13th of January, I saw that coming a day or two before it came, and I called it to within a couple of points. If I wanted to, I could have gotten into that trade with about 5 points of risk. That's how close you can get it. It's very rare that you'll get into a trade with 1 point of risk because A, there's a spread, there's a bid-ask spread, and B, you're going to want to allow a couple of points leeway in the market, but you can get very, very close and you can get those very big position sizes on very small risk if you've got the margin in your account to be able to take them. Let's go one step further. Let's say you're a little bit slow off the mark and you get into the trade a little bit late and your stop loss is now half a cent away or 50 ticks away. It might not sound like very much, but at 50 points of risk, your position size comes all the way down to 28,620. So again, the lesson here, can you see the value of entering early? You're getting much more bang for the same amount of buck, and you're getting a much higher reward to risk ratio. So let's walk through each of these entries now. We'll have a look at the position sizing, and we'll have a look at the reward to risk ratios as well while we're there. So example number 1, entry at 72.91. Keep in mind our position sizing formula equals the dollar risk divided by the points risked. Now the dollar risk on the trade is $146.30 US, and we get that by multiplying our Aussie $200 by the price of our stop loss at 73.15. Keep in mind, we have two different stop losses. This trade, the stop was at 73.15. So we multiply our 200 Australian dollars by 73.15. Here, the stop loss was 72.77. So this $200 risk will be multiplied by 0.7277. So they will be slightly different, and that's going to affect the position sizing. But here we go. On this entry number 1 at 72.91, we use the figure for the stop loss, which is 73.15. We multiply that by our $200 risk, which is 2% of our $10,000 account, and that gives us a risk of $146.30. We're entering at 72.91 with a stop at 73.15. Do that on your calculator, work out the points risked on that trade, and you'll find that that is 24 points, which is 73.15 minus 72.91. And when I'm doing that on the calculator, I will just ignore the 0 point and I will just type 7315 minus 7291 and you get the same answer. The reward is 298 points, and that gives us a reward to risk ratio of 12.4 to 1. Now, that figure is correct, but it will change slightly because we're entering the market with a risk based on this exchange rate, but our profit is based on our profit target of 6993, which is a lower price. And if we make a profit, we convert it back from US dollars to Australian dollars using a different exchange rate. So this reward to risk ratio will be very close, but it will be slightly different. If you are trading a currency and the price of the exchange rate goes down, the reward to risk ratio should go up, and vice versa. If the price goes up, then the reward to risk ratio will go down slightly. And you'll see how that works in a moment. But here, what I'd like you to do is pause the recording and see if you can work out the position size that we're going to take here. Remember, we're plugging in position size. That's the number that we want. And we're putting into our calculator risk in terms of dollars divided by points risked, which is 0.0024. See what you come up with. I hope you took the time to do that exercise, and I hope that you got the same answer as me at 59,833. Now, for trading purposes, you would probably round that down to a neat 59,000. So let's look at how that trade pans out. The position size is 59,000 Australian dollars. Can you work out how much the profit and loss is going to be per tick on this trade? Think back to the table that we looked at earlier. For a 10,000 Aussie dollar position, your profit and loss is going to be $1 US per tick. Well, $59,000 is 5.9 times $10,000. So our tick value is going to be US $5.90 per movement of 0.0001. So our reward is 298 points. So our profit on the trade is going to be US $1,758.20. Not bad for 200 Australian dollars risk in about 2 weeks. So we then convert that back to Aussie dollars at the new rate at 6993, and that gives us a profit of $2,514.23 Australian. Now, if we divide that figure by our original risk of $200, we've actually got 12.57 to 1 reward to risk ratio. So we've made money on this trade in 2 ways. We've made money as the price fell, and then we've made a little bit of money on the conversion. If we had been wrong on the trade, we would have converted our loss at the higher exchange rate. But in making a profit and converting it at the lower exchange rate, we're getting more Australian dollars for each US dollar there. In other words, the US dollar is now stronger than it was earlier against the Australian dollar, and we have US dollars, so we're converting them at a stronger exchange rate. If you flip this around, now you would say the Aussie dollar is weaker than it was earlier. So earlier it was at 73, now it's at 69, so it's weaker. And if we had Australian dollars going to US dollars, we would be worse off than if we were converting them at that 73-cent exchange rate. So that's example number 1 of position sizing. We're going to walk through entry number 2 now, and I'd like you to work through each step of this on your calculator as you go and make sure that you understand it. And if you do have any questions, safety in the market students, you know that as safety in the market students, you can ask the trading tutors a question at any time. Just send them an email and they will help you with that without any problems at all. Or if you're one of the students in my coaching class, you can ask me during our next live session together. So let's look now at entry number 2. Remember that our position size equals dollar risk divided by points risked. So I'll get you started on this one. Our risk on this trade is going to be 145.54 US. So that's slightly lower because, as you can see, we've got a stop loss at 72.77 for this second entry. So it's a slightly worse off deal for us if we're converting our money into US dollars. So we can only risk a slightly smaller amount of US dollars on this trade. Now, we already know that the entry is going to be at 72.62 and that the stop loss is at 72.77. Using those figures, work out how many points we're risking on this trade. You might like to pause and work this out for yourself on the calculator. Then when you're ready, you can resume the video. If you said a risk of 15 points, you'd be correct. So 72.77 minus 72.62. Now, can you remember the reward on the trade? What was the profit target that I was working to? It's the same profit target as trade number 1. It was 6993. So again, if you'd like to pause the recording, the profit target is 6993. Work out your reward on this trade. So hopefully you got the same answer as me. 269 points is the reward. Now what I'd like you to do is to calculate the reward to risk ratio on this trade. And once you've done that, we'll have a bit of a discussion about it because it's very interesting. Hopefully you came up with the same answer as me, 17.93 to 1, and we get that by dividing 269 by 15. Now, before we go on and work out the position size, take a moment to think about this. This was the same campaign, and this trade was taken in the same short trade as the previous short trade, but it was taken a week later, and it's at a lower price than the previous trade. But look at the reward to risk ratio, 17.93 to 1. The previous trade had a reward to risk ratio of just over 12 to 1. So why is this one so much larger at almost 18 to 1? The reward is lower, but so is the risk, and the percentage risk is a lot lower, whereas the reward is only a small amount lower. So with that smaller risk, with that tighter entry, the reward to risk ratio increases substantially. And the reason I was able to get a small risk like that on this trade is that I was able to pick that top almost precisely to the point, that lower top on the 20th of January. So with price forecasting, the closer you can get to the turn, the smaller your risk, and then the higher your reward to risk on the trade. And as I'm sure you can appreciate there, that is a 17.9 to 1 reward to risk ratio in a week's worth of trading. And that is the sort of trade that you should be looking for. That's the kind of trade I discuss in our video, Trading the Easy Way. And as I said, that's the sort of trade that students at Safety in the Market look for. And it's all taught in the Active Trader program. So the last step here is to calculate our position size. I'll let you go ahead and do that now. Pause the recording and do that on your calculator. So I hope you got the same answer as me. US $145.54 divided by 15 points risked gives us a position size of $97,026.67. And for the purposes of this exercise, we will round that down to 97,000. So let's talk now about the profit on that trade. Position size is $97,000. Think to yourself, what is going to be the tick value of each 0.0001 that this currency pair moves? It's going to be in US dollars, and it's going to be how much? It's going to be $9.70 US per 0.0001. Now the reward is 269 points. Calculate the profit on this trade in US dollars. And again, pause the recording while you do that. So the profit, 269 points times US $9.70 equals US $2,609.30. Now, when this profit was made, the conversion rate or the exchange rate was 0.6993. That's where we took profits. So convert that US dollar figure of $2,609.30 back into Australian dollars using the exchange rate of 0.6993. As you can see, that gives us Australian dollars of $3,731.30. A good point to note here is that when you're looking at the Aussie dollar US, you were multiplying by the exchange rate to go from Aussie dollars into US dollars. But then when you're going from US dollars back into Aussie dollars, you're actually dividing by the exchange rate. An easy way of knowing this, though, is if one Aussie dollar is worth less than one US dollar, well, your Aussie dollar figures here are always going to be more than your equivalent US dollars. You're going to need more Aussie dollars in order to match the same number of US dollars. So there's a little trick to remembering that there. Now, one last thing for you to do, based on our initial risk of 200 Australian dollars, work out the reward to risk ratio on this trade. And as you can see there, 18.65 to 1. Add to that 12.5 to 1, and you're at 31 to 1 reward to risk ratio from 2 simple trades in about 2 weeks worth of trading. Now, again, I talk about that in our video, Trading the Easy Way, but that's where you want to be as a trader. You don't want to be in front of the screen eking out a 1.5 to 1 or a 2 to 1 reward to risk ratio by sitting at the screen 12 hours, 16 hours a day, glued to the screen, looking for those little tiny opportunities to scalp the market. You want to do your work, identify those price cluster areas, identify your price forecasts, wait for the market to approach them. When it does, get in there quick, smart, and take your trades, and then sit back and let the market do whatever it's going to do. It's either going to stop you out for a loss, in which case you sit back, you reconfigure, you look for the next opportunity and move on, or you're going to let it unfold over that 1 week, 2 weeks, maybe it takes 3 or 4 weeks, but even if it takes 6 weeks, 31 to 1 is a pretty good return on your capital for a simple entry like this into the market. So let's recap our position sizing. We've covered a lot of ground here. The formula that you need to remember, your position size equals your dollar risk divided by your points risked. And you can always play around with your final figure. You can do the calculation and you say, oh, my position size should be 2.8 million. Well, work out what your points should be per tick and then multiply that by your points risk and see if it adds up to your dollar risk. Sometimes you can make a mistake on the calculator, so if it doesn't quite look right, just double check it. Another way of double checking it, of course, is to look at your broking platform. It will tell you, based on your position size, based on where your stop loss and entry prices are, it will tell you what your profit and loss should be. Again, remember, the smaller that your points risked figure is, the larger your position size will be for the same amount of risk. And the way, as I said, to get that points risked as small as possible is simply to learn how to price forecast. So again, if you would like to look into that and begin that journey, click on the link in the description and go and check out the Active Trader Program online training. Free of charge, no credit card required to view that demo and to watch those early videos. They are actual videos from the Active Trader Program online training. So click on that link, go and check them out now if that's of interest to you, if you're interested in being able to forecast market prices before they happen. Also remember, as I said, before you click to execute a trade, just double check on your broking platform. Make sure it all looks okay, particularly the amount that you're risking on the trade. Make sure that it doesn't exceed your 2% or whatever you're risking on your account. So let's finish up with some questions for you to ponder. Number 1, how do you handle a margin call? Number 2, what percentage of your account will you use as margin? Not as risk, as margin. And remember that you need to consider what percentage of your account you'll use as margin for one market and what percentage as a total across all of your trades will you use as margin. Question 3, what percentage of your account are you prepared to risk on each trade? Don't worry about what I want to risk. Don't worry about what your friends or other traders want to risk. What percentage of your account are you comfortable risking on each trade? And finally, ask yourself, do I understand how to calculate my position size? If not, go back and rewatch that portion of the video. And again, if you are a safety in the market student, remember that you always have that support in the form of our trading tutors team. So you can send them an email and they're more than happy to have that discussion with you. That's all for part 4 of the FX trading course. Still to come in part 5, we're going to have a look at analysis, both fundamental analysis and technical analysis. Then in part 6, we're going to take a trip down memory lane and have a look at some lessons from history before we finish up in part 7, where we will set up for an FX trade from start to finish. Hope you've enjoyed the video. If you did, please click on the like button. And if you haven't already done so, please subscribe to the channel and that will keep you up to date and let you know when video 5 is out. Until our next video, all the best with your trading and bye for now.